What happens if a large Roth conversion subjects you to Medicare premium increases? This is a common question that we receive at Safeguard Wealth Management because as people are looking at their large tax-deferred balances, and they start to put together a forward-looking tax plan, they see that once they turn 72, required minimum distributions, otherwise known as RMDs, really rain some tax havoc on their situation. Now, there are a few things that you can do to minimize RMDs. A core strategy is Roth conversions, specifically in this window of opportunity that we have with the Tax Cuts and Jobs Act. But what happens when performing a large Roth conversion subjects you to a Medicare premium increase? How can you weigh through whether it still makes sense to perform that large Roth conversion versus weighing through the drawbacks of that given penalty? Well, this can be a fairly complex situation for retirees to wade through. We'll talk through a few reasons why. But we've also recorded a few different videos on performing Roth conversions and if they make sense. But in today's video, I want to walk through a scenario that every retiree will face at least once in their retirement that essentially makes Medicare premiums a non-factor in this Roth conversion analysis. Make sure you watch this video until the end as I will go through some important details that you want to make sure that you know about. But if you end up liking this video, please hit the like button down below. It will help retirees just like yourself find this video. Now, what am I specifically referencing when I talk about Medicare premium increases? Well, there is a guideline that the government lays out for you called IRMAA. It stands for Income Related Monthly Adjustment Amount. And in layman's terms, essentially what IRMAA is, it's a guideline that if you show too much income in a given year, it will cause your Medicare premiums to increase. Now, IRMAA is fairly complex to weigh on an ongoing basis. There are a couple reasons for this. One, it's a 2-year look back. So the first year that you are on Medicare at age 65, it will look at your income in the year that you turned 63. And the income that you showed will determine how much you owe for Medicare premiums at age 65. It's also based off something called modified adjusted gross income. It's not based off taxable income. Taxable income, you get to take out the standard deduction. Modified adjusted gross income, you have to add it back in. You also have to add in other things that are previously thought of as tax-free, like muni bond interest. Now, it's important to note that IRMAA is only on a 1-year rolling scale, meaning that if you're subject to an IRMAA penalty, it's only for that 1 year. The following year, they'll look at, again, 2 years prior to that and determine if you have another Medicare penalty for that given year. And so as retirees start to build a forward-looking tax plan, they often see that large Roth conversions are a necessity, especially for those that have large tax-deferred balances. So this is an example on the screen right here of a forward-looking tax graph. And as you can see, this person is in some fairly low tax brackets early in retirement when they're not subject to RMDs yet. But once they turn 72, we see that these green bars here, RMDs, keep rising throughout their retirement and force them into some pretty negative tax consequences. There are various tax hurdles they will be subject to. And obviously we see that their RMDs push them into higher tax brackets that, again, ultimately they wouldn't be subject to if they didn't have that given RMD. And so we know this person needs to be doing large Roth conversions, but what happens when that large Roth conversion subjects them to IRMAA? Now, again, this can be complicated on an ongoing basis, but there is one specific scenario that I would urge many of you to take the Medicare penalty for, and that is the very first year that you turn 65. And why is that? Well, if we think about this entire scenario that I'm going to be talking through for the rest of the video relies on one simple question. When is your birthday? When your birthday is will determine how severe that given Medicare penalty is. For instance, let's say in a quick example that your birthday is November 1st. This is the first year that you're filing for Medicare. And let's say that you have a premium increase due to a large Roth conversion at age 63. Well, because your birthday is later in the year, you're only subject to IRMAA for the time that you're on Medicare. Well, if you're on Medicare from November and December, you're subject to a very small penalty relative to if your birthday is January 1st. You may be subject to IRMAA for the entire year. So every retiree will have a differing penalty in that very first year that they file for Medicare based on when their birthday is. For instance, let's say that your birthday again is in November. Well, if you file in the given month that you turn 65, okay, you will only have Medicare costs for November and December, for 2 months there. Prior to that, you'll have whatever other healthcare option you had prior to Medicare, whether that's ACA insurance, whether that's some kind of continuation from work, or whether that's some kind of health sharing plan. And so let's take a scenario where someone at age 63 performed a large Roth conversion in order to deal with tax deferred issues down the road. And so they subjected themselves to IRMAA in that first year. Well, when they file for Medicare in November, they will have a IRMA penalty. Their Medicare premiums will increase, but only for those last 2 months. And so IRMA controls Part B as well as Part D premiums. If we add together the extra expense of going through that first Medicare threshold, their total that they would owe as penalties would be $80.40 extra per month. Well, this is only for 2 months. And so this is something that we factor in with all of our clients. I'm going to make my head a little bit smaller here. But as we start to think about if taking an IRMA penalty makes sense, it's first important to note that when you're subject to IRMA, IRMA is like a tax cliff. On the screen right here, we see that the first penalty here starts for 2022 starts when a married filing jointly couple shows income higher than $182,000. Now, if they show $182,001, again, it's a tax cliff, meaning that they will owe the full penalty for the full year, even though they only showed $1 more than this given threshold. And so something that we do with all of our clients is we look at the given penalty relative to the extra conversion room that we get. So let's take a scenario here with somebody whose birthday is in November. They're a married filer. And so we see that to go into this first zone here, it's going to open up essentially another $46,000 of room where they can perform a Roth conversion. Now, performing that extra $46,000 of a conversion will subject them to that given penalty. But remember, their birthday is in November. So they're only going to have 2 months worth of Medicare penalties. At $80.40 per month, that will subject them to $160.80 in penalties. And so when you're figuring out whether an IRMA penalty makes sense to take for that given larger Roth conversion, you want to look at the extra room you get for a conversion relative to the 1, tax rate that you need to pay, and then 2, the penalty translated to a marginal tax rate. And so what we see here is $160.80 divided by 46,000, and we get a 0.34% additional marginal tax that this given retiree is subject to because of that IRMA penalty. Now, in the grand scheme of things, as they're converting in the 22 and 24% bracket, 0.34% as an additional marginal tax is almost a non-factor. And so for this given retiree's tax situation, depending on what their forward-looking tax plan looks like, it makes sense for them to take a Medicare penalty. In fact, it's kind of a no-brainer. Even if this retiree went into higher zones here and took additional Medicare penalties, they would still owe the corresponding penalty increase, but it would only be for those last 2 months of the year. Now, it's important to note in the initial year that you turn 65, you have a Medicare initial enrollment period that starts 3 months before the month that you turn 65 and is 3 months after the month that you turn 65. So you essentially have a 7-month time period there where you essentially get to choose when you enroll for Medicare without penalties. And so this offers retirees some flexibility. Let's say that your birthday is in June. Well, you have until September in order to sign up for Medicare. And so if you're subject to a Medicare penalty, you may want to push back your enrollment period back as far as possible, because that means less months that you will be subject to that IRMA penalty and thus allow for a larger conversion. And so this is a scenario I often see retirees forgetting about. And when they see that they may be subject to a Medicare premium increase, after all, it's a penalty. So they try to distance themselves from that given Medicare penalty. But in the very first year that you reach 65 and go on Medicare, you likely have a lot more room for a larger conversion 2 years prior, even though you may be subject to that Medicare premium increase. Now, for retirees that are on an ongoing basis, even after the year that they turn 65, trying to figure out how to weigh the benefits of a large conversion versus the drawbacks of a given penalty, we have a video that should be linked right next to me that you can click on, talking through how to determine if a Roth conversion makes sense on an ongoing basis if it subjects you to premium increases. Always remember, you don't need more money, you need a better plan. Thanks for watching. We'll see you in the next video.